Good evening. My name is Tim Driscoll. I'm your host for this evening, and on behalf of my colleagues, your financial advisors, I extend a warm welcome and a thank you for your trust and confidence that you've placed in us all. Marissa Cartino and Stephen Cartino and I will be monitoring Kurt's presentation titled Social Security and Retirement Planning, a hit or myth proposal. This is scheduled for 45 minutes plus questions. Your microphones will be muted to eliminate any background noise, and hence all questions need to be typed into the Q&A function on your screen. At the end of Kurt's remarks, we'll answer as many questions as possible as time allows. Kurt spent 34 years building a career at the Social Security Administration before retiring in 2010 as the New England Director of Communication for the Social Security Administration. Over that period of time, Kurt developed a clear understanding of the public's need for clarity regarding the workings of the Social Security Administration and the benefits provided by the Social Security Administration. So Kurt, the stage is set now for you to share your insights and help our clients out. I'm turning it over to Kurt.
So good evening, everyone. As Tim said, my name is Kurt Czarnowski, currently the principal in Czarnowski Consulting. Those one or two in the webinar not intimately familiar with us, always proud to say we're an international consulting firm whose world headquarters conveniently located right here in the spare bedroom of my house in Norfolk, Massachusetts, which is where I'm coming to you from this evening. As Tim had mentioned, I worked for the Social Security Administration for 34 years. That's why the tagline here at Czarnowski Consulting is we provide expert answers to your Social Security questions. Because when I was working for the agency, and now for the past 12 years or so, I spent most of my time being, as our Canadian friends would say, oot and a boot, talking to people about the Social Security program. And I enjoy doing it, but I also believe there's a real need for the information. Because believe it or not, the Social Security program is now a little over 86 years old. And each and every month, the Social Security Administration pays about $93 billion in benefits to just over 65 million people. And on top of that, there's another 176 million folks, like many of you in this webinar this evening, are currently out there working and paying into the program. And so what I saw during my time with the agency, and now that I'm out here on my own, is despite the age of the program, despite the size of the program, frankly, despite economic impact Social Security has in this country today, unfortunately, the myths and misunderstandings that are out there about what it is, as well as what it isn't, are frankly staggering. Nobody knows nothing about the program, as best I can tell, so I was excited to accept the invitation to spend the next 7 or 8 hours with you, dispelling, oh, all right, got about 45 minutes or so, sharing some of the things I think it's important for you to know about the program is, and probably equally importantly, what it isn't. And why it's so important these days? Simple, 2 words: baby boomers. 75 million of us storming towards retirement, just now starting to wake up to the fact the Social Security program may play a bigger part in our retirement than we had ever anticipated. We're also starting to recognize that maybe we don't know as much about the program as we should, and we're struggling to catch up. So in our time together tonight, I want to give you some good, solid information about what the program is, help you recognize what it isn't, excuse me, dispel many of those myths and misunderstandings that are so prevalent, and set you down the road to the comfortable retirement we all hope to enjoy. Most important slide in the presentation is going to be this one. You hear me reference it numerous times. You need to understand that when Social Security was created more than 86 years ago, the program was put in place simply to provide folks with a base or a foundation of income that they could definitely count on being there for them, but it was a base of income that people needed to take steps to supplement because it was never intended to be anyone's sole source of income in retirement. But unfortunately, these days, about 21% of retiree couple households, the Social Security money they receive each month is virtually the only income they have. That's a terrible situation. So how do you avoid that happening to you? Well, simple. By planning for your retirement, and you'd be commended. Taking time out of your busy schedule, spending a little time with us this evening, learning about the Social Security program and planning for this aspect of retirement. Now, for the longest time, the Social Security Administration tried to play a proactive role in helping you plan for your retirement. Because back in the day, they used to mail anyone 25 years of age or older an annual Social Security statement, paper document designed to show up in your mailbox about 3 months before your birthday each year, giving you important retirement planning information. The statement provided you with benefit estimates at 3 different ages: 62, your full retirement age, or 70. And we'll talk in a second why those are important ages. But the other thing the statement did that was so important, it provided you with a nice year-by-year breakout of what the Social Security Administration had recorded as your work and earnings under the program. We'll see in a little bit that what you collect each month is directly related to what your work and earnings have been. So when you get that statement each year, it was important to review it and make sure that the earnings information that had been credited to you was accurate. Because if it weren't, it was important to catch that and correct it, because if you didn't, have a direct impact on what you eventually received. But you may have noticed, hey, I haven't gotten one of those every year lately. What's the deal? Well, Social Security has significantly altered its distribution plans for Social Security statements, and they no longer mail paper documents to anyone and everyone 25 years of age or older. Instead, what they've done first and foremost is put in place a system whereby if you go to www.socialsecurity.gov/my-account and take about 15 or 20 minutes or so to set up an individual My Social Security account for yourself. An important byproduct of having that account in place is you'll be able to download through a secure website a Social Security statement for yourself whenever you need one or want one. You're going to meet with the folks at Driscoll Financial, do some retirement planning. Being able to download and bring a current Social Security statement to that meeting going to make it a more worthwhile exercise. So a big homework assignment from me to you this evening is, if you have not yet set up an individual My Social Security account for yourself, I really encourage you to do so. Down the road, once you start to collect, you'll see a lot of advantages flow from having that account in place. But prior to retirement, the big advantage is you'll be able to download a Social Security statement for yourself whenever you need one or want one. So I encourage you to do so. Incidentally, Social Security has decided to resume mailing paper documents, albeit on a very, very limited basis. And what they say these days is, if you're 60 years of age or older and you haven't set up a My Social Security account for yourself, they will mail you a paper statement each year, same old schedule, about 3 months before your birthday. But that's it for paper mailings. Anyone under the age of 60, the only way you get that Social Security statement is by setting up that My Social Security account. But in my view, even if you're over the age of 60, I think it makes a lot of sense to set up that My Social Security account, because you're going to come in, meet with Tim, meet with Marissa, meet with Stefan. Being able to bring a current Social Security statement to that meeting is going to make it a far more worthwhile exercise. So, key message: plan for retirement, utilize that Social Security statement, that key planning tool. It was intended to help you understand the program's designed to get you that base, that foundation of income that you can count on being there. But it's a base of income you must take steps to supplement. And the sooner you start to take those steps, the more likely you are to have that comfortable, secure retirement we all hope to enjoy. So let's talk about retirement benefits and retirement planning. And as I travel around the country and talk to people, wait a minute, who am I kidding? I'm not traveling anywhere and haven't been traveling anywhere for the past 2 years. I've been locked away here in splendid isolation at the world headquarters of Czarnowski Consulting. But back in the day, I did used to travel around the country and talk to people about retirement benefits. And as I talked to folks, I think the most frequently asked question had to be, well, when should I take my money? That's what most people are interested in learning about. So understand this: under the rules of the program, you've got choices and you've got options. And what I'm going to try to do this evening is make sure you fully understand those choices and options. In other words, you understand what you can do under the program. But ultimately deciding what you should do, I believe firmly that's your choice, your decision. After all, you're the ones who worked and paid into the program. I can't tell you what you should do. But my view also is, though, if you don't fully understand what you can do, you're in no position to decide what you should do. So let's make sure you understand the choices that are available to you. And the place to start is by making sure you know what Social Security calls your full retirement age. When the program started back in 1935, full retirement age set as the month you turned age 65. It was 65 for everyone without exception, and continued that way, in fact, till 1983, when Congress changed the law and increased Social Security full retirement age for anyone born in 1938 or later. Now, the increase gradually been phased in over time. For a big chunk of us baby boomers, any of us happen to have been born between 1943 and 1954, our full retirement age was the month we turned age 66. But it's important to note it continues to increase beyond that, and tops out that anyone born 1960 or later has a Social Security full retirement age as the month you turn age 67. Now understand this. In terms of collecting benefits, starting at your full retirement age isn't your only choice. It isn't your only option. But in terms of planning for retirement, it's important that you know what Social Security considers your full retirement age month, because you'll see as we go through the discussion this evening, a lot of features of the program do flow from at least having reached your Social Security full retirement age. But in terms of collecting benefits, you have to start the month you hit your full retirement age. That means one thing and one thing only. It means you'll receive 100% of the amount your work and earnings entitled you to collect. As I said, we'll talk in a second how that all gets calculated. But starting at your full retirement age month, you get 100% of your benefit. But among many options you have are start collecting prior to reaching your full retirement age month, if that makes sense for you. And under the rules today, you can start to collect as early as the month you turn age 62, or at any point in between, by the way. But here's the thing. Social Security, as the name implies, is a social insurance program. And Congress has built certain social goals into it. And one is a hope that at the end of the day, based on average life expectancy, you'll end up with roughly the same amount of total lifetime benefits, regardless of when you start to collect them. And so you have to start collecting prior to reaching your full retirement age month. Well, then, because by starting sooner, in theory anyway, you'll now be collecting for a longer period of time, you'll find that your monthly benefit amount gets reduced. How much a reduction? Well, that full retirement age amount gets reduced by roughly 0.5% for each month prior to your full retirement age that you collect it. 0.5% per month translates into 6% per year reduction by starting early, but you don't have to start right on the first of the calendar year. You don't have to start right on your birthday. But if you opt to start collecting prior to reaching your full retirement age month, you'll find that that full retirement age benefit has been reduced by roughly 0.5% for each month that you're going to be collecting. And oh yeah, it's a permanent reduction. Now, one of the myths I've seen over the years is too many people mistakenly think, yeah, I know I'll start early, I'll get less, but as soon as I hit my full retirement age, my payment will zoom back up. A permanent reduction. Again, the idea being, by starting sooner, in theory, you're going to be collecting for a longer period of time, so you're going to be given less on an individual monthly basis, but based on average life expectancy, it's all supposed to come out about even. Now, as I mentioned, start right at your full retirement age month, you get 100% of your benefit. But among the options you have are to wait past full retirement age before starting, if that makes sense for you. And with that social insurance idea in place, if you opt to defer past full retirement age before starting, well, now by starting later, in theory anyway, you'll be collecting for a shorter period of time. So by all rights, your payment amount ought to be increased if you wait. And it is. These are referred to as delayed retirement credits. And for each month past your full retirement age that you opt not to collect, you'll see your payment now increase by 0.2% 2/3% per month translates into an 8% per year increase by waiting. But again, you don't have to not collect for a full year. For each month you defer, benefit permanently increased by that 2/3%. But here's the key thing. These delayed retirement credits only accrue from your full retirement age month until the month you turn age 70. Now understand this, with Social Security, you never have to take your money. Not like there's a required minimum distribution like there is with your IRAs or 401ks or 403bs. But under the rules of the program, you opt to defer, excuse me, from your full retirement age month until the month you turn age 70. You'll see that full retirement age benefit amount increase by 2/3% for each month you've deferred. You opt to wait past age 70 before starting. While it's your right to do so, you're not going to see any additional increase by opting to wait past age 70 before starting. So I'll give you an example to illustrate what I'm talking about. We get somebody full retirement age of 67. And let's say at her full retirement age of 67, she'd receive $1,000 a month. What are the options that are available to her? Well, she wants to start earliest point right at age 62, the way the reduction factor works out. She'll get 70% of her full retirement age amount. In other words, she won't get $1,000 a month. No, she'll get $700 per month and continuing. Well, yeah, she'd be getting $300 less each month than she'd receive if she waited. But the trade-off, obviously, starts to receive that lower amount sooner, and then in theory anyway, collects it for a longer period of time. If she'd start at age 64, she'd get $800 a month and continuing. At her full retirement age of 67, that's where she gets the $1,000 that her work and earnings entitle her to collect. Let's say she wants to wait all the way until age 70 before starting. Well, at that point, that 3 years worth of deferral will mean that her monthly payment has been increased by 8% for each one of the 3 years she's waited. And it's simple interest, not compounded. But it means her payment at age 70 is not going to be $1,000 a month and continuing. No, it's going to be $1,240 per month and continuing. Well, let's say she wants to wait and start at age 72. So it's going to be that same $1,240, right? Because there are no additional delayed retirement credits past age 70. Bottom line in all of this, as I said right up front, I think it's your choice, your decision. What are the things you ought to be thinking about? Well, you know as well as I do. Your health, for one. Longevity for a second factor. Always like to ask, do you come from a family of long livers? Or do you come from a family of short pancreases? Ba-dum-bum. Hey, it's a line out of the movie Goodbye Columbus from 50-something years ago. I can't take credit for it. Do you need the money? You're going to keep working. All those factors come into play. But the whole idea always used to be based on average life expectancy. It wasn't supposed to matter. You're supposed to end up with the same total amount of lifetime benefits regardless of when you started to collect. But here's a news flash. Life expectancy is increasing. Social Security numbers say 65-year-old man today, on average, going to live to age 84. 65-year-old woman, on average, going to live to age 86. But even more telling to me, Social Security numbers say of today's 65-year-olds, 1 in 3 expected to live to age 90, 1 in 7 to age 95. We boomers and those come beyond us need to recognize that for us, retirement could be a period of 20, 25, or maybe even 30 years in length. And so my personal view tends to be that because for most of us boomers, as we head into retirement, if we have any type of pension at all, it's far more likely to be the defined contribution type, 401k, 403b, 457. We're walking out the door at retirement, not with a guaranteed stream of lifetime income like you used to get with that traditional defined benefit pension. No, we're walking out the door with a pile of money. It seems likely to be that later in retirement, that pile of money will have diminished somewhat. Later in retirement, healthcare costs may be higher, so you may have a greater need for a higher monthly income later in retirement than when you make that initial transition. But again, it's not for me to say. But because of the fact life expectancy is increasing, I do tend to think that good things come to those who wait. But the whole idea when Congress set the reduction rate, increase rate, was all supposed to come out about even. But again, with life expectancy increasing, I do tend to think good things come to those who wait. But it's your choice, your decision. Just a quick reminder, once you start to collect, the decision to collect Social Security retirement benefits doesn't have to be an irrevocable one. You've got some choices and some options. The big option is if you decide within 12 months of starting to collect benefits that you've made an incorrect decision, you have the right to exercise what used to be called the Social Security do-over. To do that, you technically withdraw the application that you had submitted. You're required to repay any benefits that had been received, but the key thing is you simply repay the principal. There's no interest charged, and then you're free to reapply at a later date, and your payment rate won't be based on that initial application, but it'll be based on whatever the new application date is. Key thing is here, you have to exercise that within 12 months of becoming entitled to benefits, and you're limited to one withdrawal in a lifetime. But I also want to remind folks of this, that once you have reached your full retirement age, one of the options that you have under the Social Security program these days is to request what is called voluntary payment suspension. What do we mean by that? Well, say you decide to start collecting at age 62. You hit your full retirement age and decide, you know, I've made a mistake. I probably should have waited. Well, because you've been collecting for more than 12 months, you no longer have the option of withdrawing, repaying, and reapplying. But because you're at your full retirement age, you do have the option of contacting Social Security. You can do it over the phone and asking them to suspend your benefits. By doing so, you're not going to collect anything, but for each month then that you don't receive a payment, you're back in the business of accruing those delayed retirement credits and growing your payment by 0.2% per month, 8% per year, right up until age 70. This ability to request voluntary payment suspension, again, only kicks in if you are at or older than your Social Security full retirement age. And it's important to remind folks, just because you stop your payments doesn't mean you can't resume them again at whatever point makes the most sense for you, but you'll only accrue delayed retirement credits for however long you opt not to collect benefits. But you can stop and start and stop and start as many times as you'd like between full retirement age and 70. So again, decision to retire doesn't have to be an irrevocable one. Within 12 months, you do have the ability to withdraw, repay, and reapply. But at any point after full retirement age, you do have the option of requesting voluntary payment suspension in order to earn those delayed retirement credits. So we talked about the when you can collect. Let's talk a little bit about how benefits are figured. And as I mentioned before, there's a relationship between your work and your earnings and what you eventually collect, but we'll see in a second, it's not a perfect correlation. But in calculating benefits, Social Security simply uses a formula as included in the law. A formula has a number of different steps. Now, the first step is that Social Security will go back and adjust all of your prior year earnings for inflation, bring them up to what they are in today's dollars. But then once they've done that, they calculate a benefit by plucking out and averaging, wait for it, your highest 35 years of inflation-adjusted work under the system. That's another one of those myths that are out there. I don't know how many folks mistakenly think it's based on my high 3 or my last 5, like some other pension systems that are out there. Social Security benefits are based on an average of a lifetime of earnings, these days defined as your highest 35 years of work under the system. So what happens if you don't happen to have 35 years where you've worked and paid into the program? Unfortunately, no provision for that. You've taken time out of the workforce to raise kids, care for aging parents, perhaps work for a while in a job where you weren't paying into Social Security. It's still going to be an average of your 35 highest years of work under the system. And so if you don't happen to have 35 years of something, zeros get added in for those additional years, it lowers your average monthly wage and it lowers your benefit. But here's the takeaway for this evening, another reminder about Social Security being that social insurance program that I mentioned. Because in putting that formula in place, Congress has recognized that people in lower paying jobs, less likely to have a pension, less likely to be able to save for retirement during their working years. So the system tries to help people in lower paying jobs by providing a benefit intended to replace a higher percentage of their pre-retirement income, somewhere in the neighborhood of 55% of what they're making. For a high earner, by all means, he or she receives more each month in absolute terms than the low earner does, but the formula is only designed to replace a smaller percentage, somewhere around 34%. And for the average worker these days, a Social Security payment only intended to replace around 41% of what someone's making at retirement. In no case, high earner, low earner, or even average earner, is a benefit intended to replace 100% of what you're making at retirement. Which leads us back to that very first slide I showed you. You got to recognize the program's intended to provide you with a base of foundation of income that you can count on being there for you. But it's a base of income you must take steps to supplement, because it was never intended to be your only source of income in retirement. And the sooner you recognize that, take steps to supplement your Social Security by working with Tim, Marissa, or Stefan, the more likely you are to have that comfortable retirement. A couple numbers for you to think about this evening. In the year 2022, the average Social Security retirement benefit being paid is $1,657 a month. $1,657 a month, which translates into an annual total of $19,884, just a little under $20,000 a year. But I often get asked, is there a maximum payment? Well, in the year 2022, for somebody who is at his or her full retirement age this year, someone who is at age 66 years and 4 months, and who for each of the past 35 years has had earnings at or above what the Social Security taxable maximum has been for each one of those years, that's an important point. Each year, there's a maximum level of earnings that are going to be subject to Social Security tax. This year, for example, you could make $500,000, but you're only going to pay Social Security tax on the first $147,000 that you make. Anything above that, sure, it's going to be subject to that 1.45% Medicare hospital insurance tax, but there is a cap each year on the level of earnings subject to Social Security tax. So each year, in averaging someone's earnings to calculate their benefit, Social Security only averages in earnings up to that taxable maximum. So again, to recap, in the year 2022, somebody at full retirement age this year of 66 years and 4 months, for each of the past 35 years has had earnings at or above the taxable maximum. This year, he or she receives $3,345 per month, or $40,140 over the course of the year. $1,657 average, $3,345 maximum at full retirement age this year. Nothing to sneeze at, but you got to keep in mind, it's designed to be that base, that foundation, and the sooner you recognize that, take steps to move from what Social Security provides, the more likely you are to have that comfortable retirement. Oh yeah, by the way, if I had been given the full 8 hours Tim had originally promised me, we'd be going through this in excruciatingly painful detail. And I realize there may be people on the webinar who are sorely disappointed by that. Maybe engineers, for example. But you want to learn more about benefit calculation and computations, want to direct you to the Social Security Administration website, www.socialsecurity.gov/ and then in all capital letters, OACT. OACT, which is an abbreviation for the Social Security Administration's Office of the Actuary. A lot of information that y'all know what an actuary is, right? An actuary is somebody who doesn't have enough personality to be an accountant. Bum. It's all right, I can tell that joke because Social Security's chief actuary told it to me. All right, let's keep moving on. So we talked about the when you can collect. We talked about how benefits are calculated. Let's spend a couple of minutes talking about working in retirement, because that's another area people have a lot of interest in. And this is yet another area where it's vitally important to know what your Social Security full retirement age month is. Because under the rules of the program, if you are under your full retirement age, looking to collect benefits, but intending to work at the same time, you need to understand that you're limited in how much you can earn before it begins to impact your ability to collect. And in the year 2022, under full retirement age, you're allowed to make up to $19,560 without any loss of benefits. To make $19,560 or less, you can collect all months of the year. Now you make above that doesn't mean you can't necessarily collect it all, but Social Security then is required to start holding back $1 in benefits for every $2 that you're over that threshold. So depending on how much you're making, you may not be able to collect even if you wanted to. So what counts towards that 19,560? Two things only: wages and or net income from self-employment. In other words, earned income only. Excuse me, unearned income, like a VA benefit, bank interest, 401k distributions, none of that counts. Earned income only. The great news is from the month you reach your full retirement age, though, that earnings limitation goes away. And from the month you hit full retirement age on, you can work and earn as much as you'd like each month and collect full Social Security benefits at the same time. Now, I don't know how many times I've been asked, hey, I'm retired, I'm collecting benefits, but I'm thinking about going back to work. I don't have to pay Social Security tax on my earnings, do I? Well, yes, you do. If you're in a job covered by Social Security, you will absolutely pay Social Security tax on those earnings, which is good news for the folks at Social Security because they can certainly use the money these days. But there's potentially good news for you as well, because under the rules of the program, as I mentioned, your benefit is always calculated by averaging your 35 highest years of work under the system. And it's your high 35, regardless of when they occurred. It isn't necessarily your first 35, it isn't necessarily your last 35. It isn't even necessarily 35 consecutive years. So even if you're retired, you go back to work, end of the year, you file your tax return. Social Security will automatically do a match. They'll compare that new year of earnings with the lowest of the 35 years that they had been used in calculating your benefit. And if that new year of earnings is higher than the lowest of the 35, well, they drop out the low year, plug in the new year, and it results in a benefit increase for you going forward. And this ability to increase your payment through additional work and earnings, it continues forever. Those delayed retirement credits, that bump because you haven't collected, yeah, those stop at age 70. But no matter how old you are, if you're working, paying into the system, and your new year of earnings is higher than the lowest of your 35 years of work under the system, well, then you're going to see your benefit increase as a result of that additional work. And frankly, the other bit of good news about work is it really never hurts. You've been a high-priced executive, but in retirement, take a part-time job at the local golf course, driving the beer cart around. So at the end of the year, you make a couple $1,000. Well, a couple $1,000 probably going to be lower than the lowest of your 35 years that Social Security had been using to calculate your benefit. So what happens to your payment? Nothing. Stays exactly the same because it's always based on an average of your 35 highest years of work, regardless of when they occur. So I said a while ago, I think good things can come to those who wait. I think good things can come to those who work as well, because as long as you're working, paying into the system, there's always the possibility those additional earnings will increase your benefit, and they're never going to decrease it. So let's talk about spousal, divorce spousal, and survivor benefits. A lot of interest in these topics as well. And for the longest time, there had been a number of esoteric Social Security claiming strategies that were all the rage. There are ways that couples or divorced couples could optimize or maximize their lifetime Social Security benefits. These were great deals. In fact, they were such great deals that Congress eliminated them by and large with passage of something called the Bipartisan Budget Bill of 2015, which was passed in November of 2015. Basically, all of those esoteric claiming strategies have been eliminated. So we're now back to the basic fundamentals, blocking and tackling in terms of collecting spousal benefits. So how does all that work? So whenever I talk about spousal, divorce spousal, and survivor benefits, I always like to remind folks that these programs were created by Congress largely to support the model of the American family of the 1950s and the 1960s. So to illustrate how the programs operate, I refer to what in my estimation was the prototypical American family of the 50s and 60s. In other words, the Cleaver family from the TV show Leave It to Beaver. Because in the Cleaver household, you had Ward and June, but Ward Cleaver, he was the breadwinner. Ward worked. Came downstairs each morning, he was impeccably dressed. He left the home briefcase in hand. Now we have no idea where he went or what he did, but we know that Ward Cleaver worked outside the home. Incidentally, Marissa and Stefan, Leave It to Beaver. It's on Nick at Night or TV Land. But June Cleaver, prototypical American housewife of the 50s and 60s, never worked a day outside the home in her life. In fact, she came down each morning equally impeccably dressed, right? She had pearls and high heels on at 8 in the morning, for crying out loud. But her job was to have brownies and milk available for Wally and the Beeve when they get home from school. Well, the Social Security spousal program supports the Cleaver model in the following way. Ward Cleaver, breadwinner, get a benefit based on whatever that mysterious work was. So let's say at his full retirement age of 67, he gets $1,000 a month. June Cleaver, as his spouse, at her full retirement age, going to be eligible to receive a payment equal to 50% of Ward's full retirement age amount. Or in our example, $500 a month paid to June in addition to the thousands paid to Ward, going to be paid to her even though she may not have worked a day outside the home in her life. Now, for June to collect, first and foremost, Ward must be collecting his own retirement benefit first. She can't collect anything unless and until he starts to collect. Second, June has to be at least age 62. Earliest age she can collect, no different than on a retirement program. And third, it's important to remember that the spousal payment is based on 50% of Ward's full retirement age amount, not 50% of what he may actually be collecting. So Ward waits until age 70 to collect. So instead of getting $1,000, he's getting $1,240 per month. June's spousal benefit's still only going to be $500 a month, or 50% of his full retirement age amount. But that's the 50s and 60s, right? Let's flash forward the 70s, 80s, and beyond, because now in all likelihood, June Cleaver will have worked outside the home, will have paid into the Social Security program on her own. How does that all work out? So Ward gets $1,000 a month, June gets $800 a month, they head to Social Security together. Here's the important thing. Under the rules today, June must take her own retirement benefit first. She no longer has the option of taking just the spousal benefit and waiting to collect her own at a retirement at a later date. So in our example, Ward gets his $1,000, June gets her $800. Social Security is about to say goodbye and good luck, and June goes, hey, where's that $500 spousal payment I've heard so much about? At that point, Social Security goes, sorry, June. As Ward's spouse, you can collect 50% of his full retirement age amount, or your own retirement benefit, one or the other, whichever one is higher. You don't get both at once because she has to take her own benefit first. Her $800 benefit exceeds 50% of Ward's, so that's what she collects. But let's say she hadn't made that much, though, so her own benefit was only $250. Well, the way the rules work, she takes her own $250 first, and then Social Security gives her an additional hunk of money on top of that to bring her from her own up to that 50% of Ward's full retirement age amount. Spousal benefits, 50% of the worker's full retirement age amount or the individual's own, one or the other, whichever one is higher, but you don't get both at once. But what if Ward and June get divorced? Can she collect as a divorced spouse? Well, sure, if a few conditions have been met. First condition, marriage must have lasted at least 10 years prior to the divorce. Second, for June to collect as a divorced spouse, she must be unmarried. Ward can have remarried without impacting her ability to collect on him, but she cannot be married. Thirdly, she must be at least age 62 or older. Earliest age, no different than spousal benefits or retirement benefits. Now, there is one advantage that flows from divorced spousal benefits. I mentioned if the marriage were intact, she couldn't collect anything unless he was actually collecting. But the law says in case of divorce, if they're both over the age of 62 and the divorce was finalized at least 2 years ago, she can collect as a divorced spouse even if he has not yet started to collect. So with all those conditions being met, what's she going to receive? Simple. As if the marriage was still intact. She'd get 50% of his full retirement age amount or her own, one or the other, whichever one is higher, but not both at once. And under the law, divorced spousal payments treated absolutely, totally, completely independently of anyone else in the record. So June's collecting as a divorced spouse has no impact on Ward's own benefit, nor would it have any benefit on his new spouse if he had remarried. Spousal benefits, divorce spousal benefits. What about survivor benefits? Well, here the news is a little bit better for June, because while Ward was alive, she could collect 50% of his full retirement age amount. But in cases of survivorship, her benefit's going to be based not on 50%, but 100% of what he happened to be collecting at the time he passed away. Oh, yeah, still, or her own, one amount to the other, whichever one is higher, but not both at once. So in our example, June's getting 800, Ward's getting 1,000, Ward passes away. Assuming she's at her full retirement age or older, June will now receive an additional $200 a month, moving her from her 800 up to the 1,000 that he had been collecting. That's the good news, though. But keep in mind, you collect on one or the other at a time, not both at once. So while both of them were alive, in our example, they were getting $1,800 a month in Social Security benefits, his 1,000 plus her 800. He passes away. Sure, her individual benefit goes up, but total income to the house goes down, just something you need to plan for. The other point I want to make is this: Ward, full retirement age amount, 1,000, but he's opted to wait till age 70 to collect. So at the time he passes away, he's getting $1,240 per month. Well, the better news here for June then, her benefit will be increased from the 800 she'd been collecting on her own past the 1,000 up to that $1,240 he had been collecting. So just keep in mind in deciding when to start to collect, recognize by opting to wait, not only is your own benefit higher once you start to collect it, but also means that any survivor benefit that could be paid upon your passing is going to be higher as well. Another reason why I tend to think good things come to those who wait. Widows and widowers can collect a little bit sooner, start as early as age 60, but the concept remains the same. You get a lower amount. The third bullet is the key one. With spousal benefits, when both people are alive, yeah, you can't collect just on one account and wait to switch to the other, but that is an option in cases of widows or widower payments. So June Cleaver, widow at age 60, could opt to collect a reduced survivor benefit, and then at her full retirement age or later, for example, switch over and begin to collect her own retirement benefit, and the reverse could be true. Again, you're only collecting one amount to the other at a time, not both at once, but with widows and widowers, you can collect on one account and then switch to the other at a later date. But that's not available as an option if both members of the couple are still living. Quick reminder about taxation of benefits. Prior to 1983, Social Security benefits were completely federal tax-free. That year, Congress changed the IRS code and said that if you're a higher income Social Security beneficiary, you'd be required to pay federal income tax on a portion of the payments that you had received in the prior year. How do they define higher income beneficiary these days? Well, if you're a single tax filer, you have income from all sources, earned and unearned, in excess of $25,000, couple filing jointly, income from all sources in excess of $32,000, you're now in a position of having to pay federal income tax on up to 85% of the benefits that you would have received in the prior year. Treated as ordinary income tax at whatever marginal tax rate you find yourself under. 15% always tax-free, but up to 85%, again, treated as ordinary income tax at whatever marginal tax rate you're at. About half of all Social Security beneficiaries do find themselves paying federal income tax on a portion of their benefits these days. At the end of the year, Social Security sends out a 1099 form, tells you how much you'd received in the prior year. Use that in filing your tax return. A lot of people ask, does Social Security automatically withhold a portion of my monthly payments and send to the IRS in advance like they do from my salary at work? The answer is no, they don't do it automatically. But if you'd like to have a portion withheld, you can ask that it be done. You complete a form W4V as in Victor, and at your request, Social Security will withhold a percentage of your benefits. You have four options: 7, 10, 12, or 22%. You can ask to have those withheld in advance, send to the IRS, may avoid the need for filing quarterly estimates. Now, again, this is federal taxation. In terms of state taxation of benefits, varies from state to state, but the vast majority of states, 38 out of the 50 states, do not tax Social Security benefits at the state level, including here in the Commonwealth of Massachusetts. But it leaves 12 that do. So depending upon where you end up in retirement, you just need to check with the taxing authorities in the state where you reside to see whether you may be required to pay some state income tax on your benefits. All right. So you've reached the end of your rope. With COVID and everything else, you've decided, I'm gonna retire. I'm gonna retire June 30th, and I want to start to collect my Social Security retirement benefits effective with the month of July. Well, what do you do? Well, understand this. Social Security can accept an application for benefits a maximum of 3 months in advance of the month you want to start to collect. So you've decided you want to start to collect effective with the month of July. That means anytime after April 1st, you can apply for your Social Security retirement benefit and ask to have payments begin effective with the month of July. How do you apply? Well, you get some options. To me, anyway, the simplest, best, most convenient, easiest way is by using Social Security's online retirement application, accessible at www.socialsecurity.gov. Take about 15 or 20 minutes from the comfort and convenience of your own home, day or night, starting and stopping, wearing your pink footy pajamas for all anybody knows. I encourage you to do that. But just as a caution, in order to utilize the online retirement application, you do need to have established a My Social Security account for yourself in advance. So another reason to take that as homework if you haven't done that yet. But if you're not interested in filing online, you can call Social Security, set up an appointment. At some point, offices, and maybe at the end of this month, offices will be reopening to members of the public, but they've been closed for the past couple of years or so. So any appointments for applications, they're going to be taken over the phone, but you can call, schedule an appointment. Right now, someone from Social Security will call you and complete the application over the phone with you. But as I said, some point later in the month, offices are scheduled to reopen on a limited basis. And at some point, you'll be able to call and make an appointment for an in-person interview if that's what you want to do. Here's just a quick reminder, though. Social Security benefits are paid 1 month in arrears. So you've decided you want to retire June 30th, start to collect effective with the month of July. You're going to see your first Social Security payment in the month of August. And here's another reminder. Back in the day, Social Security used to pay everybody on the 3rd of the month. But since 1997, benefit payments have been staggered through the course of the month based on somebody's date of birth. So if your date of birth falls between the 1st and the 10th, you'll always have your payment direct deposited on the 2nd Wednesday of the month, regardless of the date. Date of birth between the 11th and the 20th is always the 3rd Wednesday of the month. And date of birth between the 21st and the end of the month in which you're born, payment always direct deposited on the 4th Wednesday of the month. So you're retiring June 30th. You want to start to collect benefits effective with the month of July. Your birth date is the 25th of the month. Just recognize you're going to see your first Social Security payment direct deposited in your bank account on the 4th Wednesday of August. So you just need to make sure you plan and have some sort of income to tide you over till that point. All right, like Lady Godiva, I must come to my close. Bum, bum. That's a funny line. All right, it's like to end where I started. Said right up front, key point is to understand Social Security is designed to provide you that base of income, that foundation that you can count on being there for you, but it's a base of income protection. You must take steps to supplement. And the sooner you recognize that, work with Tim, Marissa, Stefan, the more likely you are to have that comfortable retirement we all hope to enjoy. So I hope the information's been helpful. We've been able to dispel some of those myths and misunderstandings, but I'll be happy to open it up and take whatever questions we may have out there.
Hey, Kurt, before we take the questions, I just wanted to clear up any confusion. We have a number of clients on this call who have advisors throughout the Northeast. They're all guests. So we appreciate the comments from Marissa, Stefan, and I, but probably most of these clients belong to other advisors that work with Cetera.
Oh, okay.
So I just wanted to be clear on that part. Marissa, you were managing the questions. Do you have any that we can start forwarding to Kurt?
Hi, Kurt. This is Stefan. Thank you for that presentation. It was great. One of our questions centers around some clarification around the widower benefit calculations.
Sure.
If the spouse passes away, I guess there's a couple pieces. The first piece, does it matter in the calculation if the deceased spouse had started taking their benefit yet, or if they had not taken any benefit yet?
Great question. So basically, the survivor benefit rate is going to be based on 100% of the amount the deceased was collecting at the time of death or would have been collecting had they started drawing benefits. So you've got someone, for example, who passes away at age 65, has never started to collect benefits. The survivor payment's going to be based on that deceased person's full retirement age amount. However, that person has started to collect benefits at age 65, is taking a reduced retirement benefit. The survivor benefit is going to be based on that amount the person was collecting at the time they passed away. Now, what about someone who has deferred past full retirement age? Well, again, it's going to be based on 100% of the amount the person was collecting or would have been collecting had they started drawing benefits. So you get somebody with a full retirement age of 67, intends to wait until age 70, but passes away, unfortunately, at age 68. Well, the survivor rate is going to be based on that age 68 benefit rate, and the 8% increase that applied because the person had deferred for a year, while it doesn't personally benefit the person who's passed away, it does mean a higher survivor benefit that's going to be paid. Now, that basic rate, key point, if the survivor opts to collect it prior to hitting his or her full retirement age, that benefit amount gets reduced, just as someone's own retirement benefit gets reduced if claimed early. But a distinction is with survivor benefits as opposed to somebody's own retirement benefit, you opt to defer your own full retirement age amount to a later date. You accrue those delayed retirement credits, increases your benefit, but there is no equivalent increase on survivor benefits. So it maxes out at somebody's full retirement age. So there's no incentive or no reason to wait past full retirement age before claiming a survivor benefit. Hope that answered the question.
Okay. Yeah, so I've got a multi-parter on this one. Apologies. Thank you, Kurt. All right. So, and what if the spouse passes away prior to being eligible to receive benefits on Social Security, like in their 50s, let's say?
Sure. And so basically, Social Security calculates a payment amount that represents the person's full retirement age benefit amount. Now, with retirement benefits, it's always based on an average of someone's highest 35 years of work under the system. But in calculating survivor benefits for somebody who passes away earlier, the formula is basically the same, but they're going to be averaging fewer years in the calculation because they won't have had the opportunity to work all the way up until full retirement age. So the number of years that get averaged, fewer years are averaged based on the age at which the person passes away.
Okay. And then, so if the widow's benefit is larger or would be larger, let's say if they started at full retirement age or if they started at 62, do they still have the option to take their survivor benefit and defer taking their own until for full retirement age or 70, correct?
Absolutely correct. You can collect one or the other at a time, but an option is to take that reduced survivor benefit, collect, and then at full retirement age, switch over to your own full retirement age benefit retirement, or defer all the way until age 70 and maximize your own retirement benefit by waiting. You don't forego those delayed retirement credits just because you're collecting a survivor payment at the same time. They're based on the fact you're not collecting your own retirement benefit. So you're going to see that increase. But a key thing is one or the other at a time. You don't get both full payments at once, but it is possible to collect on one account and then switch to the other at a later date. But an important thing, too, if you're talking about someone who has not yet hit his or her full retirement age looking to collect a survivor benefit, if they're still working, that earnings limitation we had touched on applies as well. Whether you're collecting a retirement benefit, a spousal benefit, a divorced spousal benefit, or a survivor benefit, if you're under your full retirement age and working, you're going to be subject to that earnings limitation we had talked about. So you could have a widow at age 60 still working, making $1 million a year. Well, she's not going to be able to be paid anything, not because she's not a widow, not because she's over the age of 60, but she's going to be subject to that earnings limitation. But as we said before, once you hit your full retirement age, that earnings limitation goes away.
Okay, great. And then the reduced benefit for starting, taking that widow benefit starting, let's say if they start at 60, what's the monthly reduction?
Yep, if you start, it's roughly the same, roughly 0.5% per month for each month prior to your full retirement age you opt to collect. But it works out, if you start right at age 60, you get 71.5% of the amount you'd receive if you waited until your full retirement age to start. The longer you wait, the closer you get to your full retirement age, the higher the percentage is. But it's a minimum of 71.5% of that person's deceased benefit amount.
Okay. And so we have a couple questions relating to how does one go about finding out what their widower benefit would be? Is the best way to just call Social Security Administration?
Yeah, unfortunately, with your own retirement amount, you can find that out online by requesting a Social Security statement for yourself. Unfortunately, though, the only way you can get a survivor benefit estimate is by contacting Social Security and asking for that information. So call them, excuse me, indicate you want a benefit estimate as a widower, and they'll give it to you at different ages, but you do need to contact Social Security to get that information. The same way you need to contact Social Security to get a benefit estimate if you're contemplating collecting as a divorced spouse. And you need to get that information from Social Security. You can get your own benefit estimate online, but as benefit estimate for a divorced spouse or a survivor, you do need to contact Social Security. And talking about spousal benefits, though, hopefully you know what your spouse is collecting, and are going to be based on 50% of that person's full retirement age amount.
Great, that's very helpful, Kurt. Next question we have, if I retire on, let's say, June 30th and start drawing Social Security and have already made over $19,560 in the first half of the year, how does that impact the benefit? Can I not work at all in the second half of the year without reducing those Social Security benefits?
Yep, and the law allows for someone during his or her first year of retirement to take advantage of a more generous earnings test. So in our example, somebody's retiring June 30th. They make $1 million between January 1st and June 30th. Well, normally, if that annual test were applied, they wouldn't be able to collect even if they wanted to. What the law says is between January 1st and the month you retire, you can make as much as you want. The key thing is, though, from the point you opt to start collecting Social Security retirement benefits, in our example, July 1st, this year, as long as you hold your earnings in each month to $1,630 or less, then you can be paid for each one of those months, regardless of the amount you had made prior to retirement. So again, it's just in that first year of retirement that allows someone to be paid regardless of what their earnings had been prior to retirement, as long as they're making a lower amount in those subsequent months. And if you figure out that $19,560 divided by 12, that's when they come up with that $1,630 per month. So it does allow, but again, only in someone's first year of retirement.
Great, thank you. All right, so next question. Can I defer my Social Security benefit and claim my ex-husband until I reach 70?
Good question. And this is one of those esoteric Social Security claiming strategies that were all the rage and were largely eliminated by passage of that bipartisan budget bill of 2015. What the law now says is, if you were born January 1st of 1954 or earlier, then yes, you have the right to collect a divorced spousal benefit. If you're at your full, you have to be at your full retirement age. You have the option of collecting just a divorced spousal benefit without having to take your own first, And you can then swoop in at age 70, for example, and file for your own at that point. But anyone who was born January 2nd, 1954 or later no longer has the option, whether they're looking to collect spousal benefits or divorce spousal benefits. Born January 2nd, 1954 or later, you are always required to take your own retirement benefit first, and you'll only receive benefits to the extent that your own full retirement age amount is less than 50% of your spouses or ex-spouses. You always get your own, have to take it first. You born January 2nd, 1954 or later, you no longer have that option of taking just the spousal or divorce spousal benefit and waiting to collect your own until a later date. So in answer to the question, it depends on person's date of birth.
Great, that's excellent information. The last question that we have here, and then we can let you scoot. Is there still the need to have paid in 40 quarters in order to collect any benefits other than spousal?
Great question. I always like to remind folks, and we focused our information tonight on the Social Security retirement program. But Social Security has a number of other programs associated with it. Besides paying benefits to retired workers, there are also disability benefits that are paid to workers and their families. There are survivor benefits to be paid to the families of workers who pass away. To qualify for a retirement benefit based on your own work record, yes, indeed, you do need to have accrued 40 Social Security credits over the course of your working lifetime. For retirement benefits, that 40, that's the magic number. If you don't have 40, you can't qualify for any type of retirement benefit based on your own work record. Although, as we talked about, it could be possible to collect based on the work and earnings of a spouse, ex-spouse, or deceased spouse. But with survivor benefits and disability benefits, you may not necessarily need to accumulate 40 Social Security credits. You need to have worked and paid into the system. You need a minimum of at least a year and a half under the system. But depending upon someone's age at the time they become disabled or pass away, benefits can be paid based on that person's work record with as few as 6 credits, the equivalent of a year and a half worth of work. So 40 is the magic number for retirement benefits. But when talking about survivor benefits or disability benefits, you don't necessarily need 40. And the specific number you need is based on the age of the person who either has become disabled or has passed away. Anyone?
We have one more question that came in. Can both a former and current wife receive spousal benefits?
Absolutely. Treated absolutely, totally, completely independent of one another. Has no impact whatsoever on each other's ability to collect. Yep.
Excellent. Well, that covers all the questions that we received here.
Okay, thank you, Kurt. On behalf of all the Cetera advisors in the Northeast and their clients, we appreciate this information. If there are any other questions, I would direct you to your financial advisor, and they can either help you out or direct us to Kurt, and we can get some more information. Other than that, have a great evening. And again, thank you for allowing us to be in your homes. Take care.
Tim, let me just reemphasize that. For folks who are out there, if you have questions that occur to you in the middle of the night, the next couple of days, get them to your advisor. He or she will get them to me, and I'm happy to provide a response to you. So don't think you don't have to get back to me.
Thank you so much.
Thank you,
Take
Kurt.
care, everybody. Stay healthy, stay safe. Spring.
Be
is
well.
upon us. Daylight savings time, 10 days away, baby.
All right. Thank you.